Welcome to The Explainer. Today, we're going to dig into something that can feel like a total black box for founders: venture capital. Seriously, understanding how VCs actually think isn't just, some nice to have insight. It's a huge advantage when you're pitching. So let's jump right in. So if you're a founder, you've probably had this feeling, right? You're in a pitch meeting and the questions just feel massive. VCs aren't just asking, hey, does your product work? No, they're asking if it can take over the entire planet and yesterday. That pressure for insane growth and these billion-dollar outcomes, it can feel totally out of sync with what you're actually doing, just trying to build a great company. But here's the thing, those huge asks, they're not random, not at all. They come directly from the high-stakes business model that VCs themselves have to answer to. So today, we're going to break that model down. The goal here is for you to stop seeing VCs as these scary judges and start seeing them as business partners who have their own set of rules and pressures. Because once you get their world, you can finally start speaking their language. And it all boils down to two key things: where VCs get their money and this relentless 10-year clock that starts ticking the second their fund exists. Honestly, this right here, it's the biggest driver behind almost everything they do. First off, and this is crucial, VCs are not investing their own cash. They're investing money from what are called limited partners, or LPs. And we're talking about huge institutions, pension funds, university endowments, you name it. These LPs aren't just hoping for a nice little return. No, they're expecting a massive one, way, way bigger than what they'd get from just putting that money in the stock market. They're paying the VCs for access to huge, risky upside. And here is the single biggest constraint: the rule of the game. A typical VC fund only lasts for about 10 years. That's it, a decade. And in that time, they have to find your startup, invest, help you scale up like crazy, and then, this is key, find an exit. That means an acquisition or an IPO so they can sell their shares and get all that money, plus a whole lot more, back to their LPs. That clock is always, always ticking in the background. So that 10-year clock, it forces them into a pretty rigid strategy. You can basically break it down into 3 stages. For the first few years, it's a mad dash to invest all that money. Then, the middle years are all about helping their companies, their portfolio, grow. And those last few years, it's all about one thing: exits. This whole structure means they are under incredible pressure to find companies that can go from zero to a massive outcome in, say, a 5 to 7 year window. A really great, stable but slow-growing business, it just doesn't work for their math. The legendary investor Ron Conway put it perfectly. He'd say something like, "Look, I know you're brilliant. I have no doubt you can make this work. But the real question is, what does making it work look like, and in what time frame?" See, it's not about if you can succeed. It's about if you can become huge, fast, within their fund's timeline. Your roadmap has to fit inside their clock. Okay, so how on earth do they manage to get those insane returns in just 10 years? Well, they definitely don't do it by placing safe bets. Instead, they're playing a totally different game. It's a high-risk, high-reward numbers game. And it's all based on a really important idea called the power law. So what is the power law? In venture capital, it basically means that a fund's returns are not spread out evenly at all. In fact, just 1 or 2 massive home run investments will end up generating almost all of the fund's profits. We're talking more than all the other investments put together. This is why VCs aren't hoping every company they back will be a modest success. They literally expect most of them to fail. This chart right here, this pretty much explains the entire VC business model. Just look at how it breaks down. You've got this huge chunk, like 60 or 70% of their investments, that just go to zero. They're complete write-offs. Then you have a smaller group that might give them a little bit of their money back, a small win. But their entire business, everything, depends on that tiny little bar at the end, the massive winners. These are the companies that return 20, 50, even 100 times the investment. They have to make up for all the losses and still generate those huge returns for the LPs. The decision expert Annie Duke said it really well. Success comes from sticking to the stuff that's working and quitting the rest. And that's exactly what VCs have to do. This is why they seem so obsessed with finding these gigantic outcomes. It's not about being greedy. It's just the math of their model. They have to find those few companies worth sticking with because those are the ones that can, potentially, return the entire value of their fund. And this right here, this creates a huge difference in focus between you, the founder, and the VC. You're completely, and correctly, focused on building a great product, solving a real problem for your first customers. But the VC, they're forced to look at it through a totally different lens. They're thinking about the total addressable market. Is it big enough? Do you have a real plan to become the #1 player? And ultimately, can you be that one massive winner for their fund? But, okay, this intense focus on finding a massive winner, it actually has a pretty big upside for you. Once a VC decides to invest, they don't just write a check and disappear. Absolutely not. They become an active partner in your business because now their success is completely tied to yours. They really roll up their sleeves to protect that investment and give it the best shot at becoming huge. They'll take a seat on your board to help with strategy. They'll open up their entire network to introduce you to partners and future investors. They'll even help you recruit key executives. Just remember, it's not pure generosity. It's a critical part of their strategy to make sure your company becomes one of their big winners. The founder, Jeff Bonforte, tells a great story about this. He said that once he realized the board was there to help, not to judge, he got way better at asking for things. He said you can literally tell your board, here's the talent I need, and basically assign them to go find those people for you. So don't be intimidated. Your board works for you. You've got to put them to work. Okay, so let's bring this all home. How do you actually use all this information to your advantage? Simple. You frame your pitch to speak directly to their business model. You have to show them that you get the game they're playing and that your company isn't just a good company, it's the winning bet for their fund. And that means your pitch can't just be about your awesome product. It has to be a story about how you become the clear winner in a huge market. You've got to lay out a believable plan for incredibly fast growth. And weirdly, one of the best ways to build credibility is to be honest about the risks and what you don't know yet. It shows you're a clear-eyed leader, not just a dreamer. Pixar veteran Oren Jacob nailed it when he said, a pitch is a live performance. You've got to know your story so inside and out that it actually seems spontaneous. You can react to the room, answer questions, but always steer the conversation back to the key points you need to make. You're not there to just read a list of facts. You're there to sell them on a vision of a massive future. A future they'll be desperate to be a part of. And in the end, it all comes down to this one question. Is your startup a great business, or is it a great venture scale business? And look, not every great company is a fit for VC, and that is perfectly okay. Knowing you aren't a fit can save you a world of pain. But if you think you are that rare venture scale company, then understanding this difference is everything. It's the key to unlocking the right kind of capital and finding partners who can help you build something truly epic. So the question for you to really think about is, are you just building a great business, or are you ready to play this game and build something massive?